Hello everyone, how are you all? So we are meeting here once again for completing the chapter, our important topic of the chapter of partnership account, final accounts of partnership for Maharashtra State Board. And this topic may be covered in other boards also. So you can also refer to this video if you do not even belong to Maharashtra State Board. So in the previous video, we had discussed what are the types of maintaining the capital accounts by the firm. There are two types of maintaining capital accounts by the firm. One is fixed capital method, under which two sets of accounts are being prepared. Number one is capital account and number two is current account. Today we are discussing the second method of maintaining capital account. This is called fluctuating capital method. So under fluctuating capital method, what happens? Under fluctuating capital method, there are no two sets of accounts. So from the student's point of view, it is much easier to make it because you have to make only one set of account, where you will write everything, whether it is drawings, whether it is introduction of capital, it is balance brought down of the capital or balance carried out of the capital and salaries and so on. So let us see in detail what is the pro forma of account, what all things come on the debit side and on the credit side, and what are the journal entries related to it. So I'm sharing my file with you. Over here you can see. So here is the pro forma of capital account under fluctuating method in front of you. What you can see on the capital account on the debit side and credit side. So as far as the format of account is concerned, this is same as what we had seen in fixed capital method. In fixed capital method also capital account and current account were maintained like this only. There is no date column because this account is made on a particular date. What is that date? That date can be the end of year, or in case of admission it can be the beginning of year. And what do we do in the amount column? And amount column, the name of partners come. If there are two partners, A and B, both the names will come. If there are three partners name will come. So it is same like cash book what we used to make last year. If there are cash column and bank column, both amounts column will be indicated like that. So similar way you have to present this. Now let us see what comes on the debit side and what comes on the credit side of this account. So as you can see on the credit side, first of all, the balance is being written. Which balance is this? This is capital account as balance. And if there is a credit balance in the capital account, it will come on the credit side over here. So what you can see over here, you can see this balance brought down is given, and when we pass the journal entries for this, there won't be any entry for bringing forward the balances. For opening balances and closing balances in journal entries, no entries will be passed, but yes, in ledger there will be a posting for this. Then after this, there is cash account, by cash account. What is the meaning of by cash account? By cash account means when a partner is bringing the capital, additional capital is being brought by the partner, then it will come on the credit side. Remember the rule which I had taught you in the last video, that anything which increases the balances of partner is going to come on the credit side, and anything which is reducing the partner's balance is coming on the debit side. If you have not yet checked my previous video, please do check it. I will give you the link in description and in the I button also. Okay, let's see what comes next. This is interest on capital. What is interest on capital? Interest on capital is provided to the partners if it is agreed in the deed that the partners are going to get interest on capital. So whatever is the opening capital on that, interest on capital will be calculated and it will be written on the credit side. And later on, this will be taken to profit and loss account. When we pass the journal entries, we will discuss about this. Then if any salary is given to the partner, we have discussed if there are active partners may get salary. So salary will be given to the partners, and it will also come on the credit side of the fluctuating capital account. Then net profit or loss means share of profit is going to come over here. In case there is loss, where is the share of loss? Then the share of loss is going to be here in profit and loss account on the debit side. Then on the debit side, what all items are going to come? On the debit side, first of all, you will have balance brought down if there is a debit balance of any partner. Is it a possibility that a partner has a debit balance? Yes, this is a possibility that a partner has a debit balance. And when does it happen? When a partner has over withdrawn, means he has withdrawn more than the capital invested by him, then it is going to come on the debit side. Then you write drawings, whatever drawings partners have done. Any interest charge on the drawings, this will also come on the debit side. And profit profit and loss means share of loss will come over there, and at the end balance sheet is going to come. So what do we see over here? Whatever we had written on the credit side of the capital account, all that is being written over here. Whatever we had written in the current account and at the time of maintaining account by fixed capital method, this has also come over here. So mixture of both, जो दोनों debit थे, the debit of current account and debit of capital account, both has come over here. So you have written opening capital, any introduction of capital is written, any drawing interest on capital is written, any kind of salary given to the partner, commission given to the partner, or remuneration, what all we had written in the current account on the credit side, all those items have also come over here under one account only. So this is easy to make because you don't have to think whether this item is going to the current account or capital account. Just one thing you have to think. What is that one thing? You have to think whether this item is of credit or debit. Okay, so very, very simple. As far as entries are concerned, let us see the journal entries. What are the journal entries? Journal entries are going to be same only what we had discussed yesterday. Journal entries, what we had discussed yesterday, are these entries only. This is interest on capital account debit to partners, capital or current account. So in this case, because we are maintaining fluctuating capital account, no current account is maintained. This is the entry. Then for transferring this interest on capital to profit and loss account, this is the entry. For salary and commission, this is the entry. I'm just going on ticking because we have already discussed this in detail in the previous class. And then profit and loss account. Then later on, cash or goods transacted. This is also going to come over here. Then after this, you have interest on drawing charge. So interest on drawing also two entries. Just remember that when it comes to passing the entries, there are always two entries. Why two entries? Because one is booking of expense or income, then closing this. Where are you going to close it? You are going to close it in profit and loss account. For example, if I talk about this particular one, let me just erase whatever tick marks I have done. If I talk about this particular one, interest charge on drawings of the partners. So if I charge interest on the drawings of partner, what is this? Think from the firm's point of view. If you think from the firm's point of view, it is an income for the firm. And where it is going to write? It is obviously going to write in profit and loss account, and it is an income. That is why it will be credited to profit and loss account. You can see over here, this is the opening entry, partners current account or capital account. If you are doing fluctuating capital, no current account is being maintained, so only the capital account is going to come. Partners capital account debit to interest on drawing account. Why partners capital account is debiting? Because remember the rule, whatever is reducing the partners capital account comes on the debit side. Is it reducing? Yes, it is reducing because he has to give this thing to the firm. And interest on capital from firm's point of interest on drawings from firm's point of view is an income. That is why it is coming on the debit side, and P&L account is recorded on the credit side because it is an income. Okay, so it's simple. What do you have to do? You have to mix both the capital account and current account and write everything under one account only called capital account. So we have covered two methods of fixed capital method and fluctuating capital method, which can be followed by the firm. If question is silent, is not saying anything regarding the method which has to be followed by the firm, then what will you do? How will you prepare the partnership account, partners capital account? You're always going to assume that the firm has fluctuating capital and you are not going to prepare two separate set of accounts. I hope this is clear to you all. We will meet once again to discuss in detail how to prepare final accounts and how to deal with the adjustment. For that video, wait. Until then, share, subscribe and like. Have a great day.